Good afternoon, good evening, good morning to everybody. My name is Stijn Claessens. I'd like to welcome you to the second annual conference webinar. After yesterday's presentation discussion, we have another interesting topic today. The speaker will be Andrés Velasco. He will speak on a paper jointly with Guillermo Calvo. It's called Joint at the Hip, Monetary and Fiscal Policy in a Liquidity-Driven World. It's a very topical issue. It's also a very good speaker. Of course, Andrés Velasco probably doesn't need any introduction. At the moment, he is the head of the public policy school at the London School of Economics. Before that, he has a very distinguished academic careers. He was at various universities, in both in England, Oxford, Columbia University, MIT, Harvard. He spent time at all of those. In addition to that, he had a very professional career, Minister of Finance in Chile, as well as at some point a presidential candidate. He's an author of more than 100 academic papers, and many of them on topics related to emerging markets. He's a consultant to various organizations and institutions. So with that introduction, let me pass the floor to Andrés for his presentation. He has 35 minutes. And then we'll move to the discussant. Andrés, the floor is yours.
Thank you very much, Stijn. Good morning, good afternoon, good evening, everyone. Thank you to Agustin and to Hyun for inviting me to this conference. Great honor to be here. I used to be a finance minister, and we finance ministers are always in awe of central bankers. So, I hope that I am up to the task. And of course, thank you to Cristina Arellano for providing comments. This is work, as Stijn said, with Guillermo Calvo of Columbia University. Let me begin with two quotes to motivate the subject matter of this paper. Everybody in the world, certainly everybody in this audience, knows that on the 26th of July, 2012, Mario Draghi said that the ECB would do whatever it takes to preserve the euro. What I did not know, maybe some of you do, but some of you don't, and I only learned of this recently, that if you go and read Draghi's whole speech, there's another paragraph, which I've highlighted here in red, on a slightly different topic, related, of course, but slightly different. He says, then there's another dimension to this, to what the ECB is doing. It has to do with the premia that are being charged on sovereign states' borrowings. And then he explains where the premia come from and adds, now to the extent that these premia do not have to do with factors inherent to my counterparty, they come into our mandate, they come into our remit. So Draghi, in a less well-known portion of his very famous speech, is saying, we worry about premia. They come within our mandate, they come within our remit. And of course, he's talking about premia on government bonds, not on any old bonds. Let me move now to a very recent paper on a much more recent episode. This is taken from the paper that Annette Wissing-Jorgensen is presenting at this very same conference. And of course, it is about COVID. It is about the market tremors in March, April of last year. I will not read the whole quote, but simply highlight that, as everybody in this call knows, when COVID hit, there was a very big spike in yields in many places, including, remarkably, treasury bonds. And the Fed stepped in and purchased over 1 trillion of treasury bonds in just 1 quarter. And Annette says, and again, the quote that I want to emphasize is in red, a central part of my analysis is to study the Federal Reserve's intervention in the treasury market in response to the spike in yields. And she documents, of course, that treasury yields started falling once the Federal Reserve intervened, beginning on the 19th of March of 2020. I am not an expert in the details of these two episodes. Many of you are, so I don't want to focus on the details. I want to focus on the big elephant in the room, the big question that to somebody like me arises when reading these statements. And the question is, should stabilizing bond prices be a goal of monetary policy? Maybe yes, maybe no. And if you conclude that the answer is yes, then the question is why? Clearly, what bond prices do will depend on what fiscal policy is doing. So one cannot answer the question of what monetary policy is doing or ought to be doing without taking a stance on what fiscal policy is doing. It doesn't have to be an optimal fiscal policy, but it has to be some fiscal policy that is causing some movement in bond prices. And the question is, will monetary policy react to that or not? And what I hope is the sort of value added, the marginal contribution of this paper is to think about a framework in which one can think about these issues rigorously. And so Guillermo and I asked ourselves the question, well, if central banks tell us they're doing this, why are they doing it? And how do we think about this? What role do bond prices play? Why do we care? Should we care? Et cetera, et cetera. So let me backtrack a little bit now and sort of set the stage a bit more broadly. Out there, there's something called money that all central bankers know about, and there's something called bonds, government bonds. In a world of very, very low interest rates, like the world we've been living in for the last decade, or maybe a bit more than a decade, bonds become money-like. They provide liquidity services and are priced accordingly. And there are plenty of papers out there, including another papers by Annette and Arvind Krishnamurti and other people that point out that treasuries are money-like in that they pay a price and they behave in a way that suggests that they yield liquidity services. Looked at from the other side of the equation, from the point of view of the issuer of a bond, or from the issuer of money, money becomes bond-like in the sense that, if the nominal rate on bonds is zero, well, the cost of issuing a bond and the cost of issuing money from the point of view of the finance minister of a country or the treasury in the case of the United States is the same. So bonds are money-like in this environment, and bonds are, and money is bond-like also in this environment. But, and this is the main conceptual point of the paper, and this is a point that Guillermo Calvo has been emphasizing for a while, this one remaining difference, even in this environment, between money and bonds. And the difference is that they're priced differently. By definition, money is the unit of account, so the price of money is the inverse of the price level. So if prices are sticky, and we will assume that they are, because there's plenty of evidence out there that prices are indeed sticky in terms of money, so the price of money in terms of goods is also sticky. It's the same thing, it's just upside down. My co-author likes to emphasize that this point was already in Keynes. One of the things that makes money attractive is the fact, Keynes points out, that I'm going to read the quote because it's a good one. The fact that contracts are fixed and wages somewhat stable in terms of money, unquestionably, the italics are ours, plays a large part in attracting to money so high a liquidity premium. So Calvo calls this the price theory of money. We like money as a store of value, as an asset, precisely because the price of money in terms of goods or the price of goods in terms of money is sticky. By contrast, the price of government bonds in terms of money or in terms of good is not sticky at all. It jumps all over the place. It moves around to clear financial markets. And even in the case of very solid, very credible, very liquid markets like the market for treasuries in the United States, the price of securities, the price of these bonds moves around a lot. So it happened during the great financial crisis. It happened in the famous taper tantrum a few years back. And it's happened several times in the last 2 or 3 years, most remarkably in March, April of 2020. So getting now to the points of the paper, we want to ask, how does an economy behave if it has two sources of liquidity, money and bonds, both of which yield liquidity services, but the prices of those two behave very differently. As I pointed out, one is sticky and one is jumpy. And in this context, in which you have these two sources of liquidity, what are the implications for fiscal policy? Because if you're going to be carrying out, for instance, a bond finance fiscal expansion, this has implications for bond prices, presumably, but this also has implications for liquidity. And if something happens to bond prices in response to, for instance, a fiscal expansion, it could well happen, and in fact it will happen, that bond prices fall. Well, will the central bank stand idle and watch it happen, or will the central bank step in? Well, if liquidity is king, and in the little model that we will write here, liquidity is in fact king, or queen, we can be equitable. I am in Britain, so I should say queen, I suppose. If liquidity is queen, can central banks afford not to stabilize bond prices? So let me just sort of give you the punchlines of this paper. We're going to write a little model, and we're going to ask what are the effects of bond-financed fiscal stimulus in this context. And I'll give you the punchline right away. We find that different kinds of bond-financed fiscal stimulus can be neutral, can have no real effects, contrary to a lot of conventional Keynesian-type wisdom. And this is the case even though we have a sticky price model, or certain kinds of fiscal stimuli that are bond finance can be contractionary, reducing aggregate demand and output and causing, at least for a while, deflation. And the main sort of deviation of our model from the standard story is that government bonds will be a source of liquidity. So when the government says, I'm going to print a lot of bonds, you will not be surprised to hear that under most plausible circumstances, the price of bonds goes down. Therefore, the usefulness of these bonds as liquidity goes down. And in a simple model we will write, that simply means that the ability of consumers to buy goods is curtailed, demand goes down, output goes down. So we have a story that makes 2 points. First of all, in a world of bond-driven liquidity, in which some prices are sticky, but some prices are not, fiscal policy can have unexpected effects. That's point number one. Point number two, that to avoid some of these effects, central banks cannot afford to simply put their hands in their pockets and do nothing. They need to do something to stabilize bond prices if they want to avoid, for instance, the accompanying recession. And that is why the title of the paper, which says that monetary and fiscal policy are joined at the hip. So that's my sort of generic summary. Of course, I skipped over a lot of the meaty details. Let me now show you one graph and then show you a tiny little model. This is the only graph with actual real-world data that I'm going to show you. This is from Fred, everybody's source for this kind of data. And what I have here is the 10-year Treasury rate in blue, and the federal debt in the United States held by the public over the monetary base. And maybe to central bankers in this room, this is a well-known fact. To me, it was not a well-known fact. These two lines don't move perfectly together, but they move remarkably together. In fact, the correlation coefficient is nearly 0.9. So this is sort of at the heart of the story that we're going to be telling here, because we're going to be telling a story in which when federal debt goes up, something happens to yields or something happens to bond prices, which is the same thing, and that's going to have all kinds of macroeconomic implications. So I don't want to treat anybody to the gory details of a macro model, but let me just sort of outline in as simple and intuitive a fashion as possible what is the toy model that we construct. It's going to be continuous time, infinite horizon. There's going to be one representative agent. It's going to have log utility. None of these things are essential, but they make our life simple. It's going to be a closed economy. Guillermo and I have been working on the open economy version of this, which is kind of an emerging market story. when Stein introduced me, he said I was mostly an emerging markets guy. That is true, and so is my co-author. So we will take this set of ideas and apply them to emerging markets, but we thought this was not a bad place to start. There's going to be one good, which is a consumption good, no investment, no capital good. And the action really is in the financial market. There's going to be money. And we don't deal with all the complications of financial markets. So you can think of money, and we're going to be trendy here, as digital currency. So, everybody, you and me and our friends and family have accounts at the central bank. We carry around a card in our pockets that we draw upon that account at the central bank whenever I want to buy something at the shop around the corner. But money's going to pay interest because I have a balance at the central bank, and the central bank can pay interest on that balance the same way central banks pay interest on reserves, and they have been in the major central banks since the great financial crisis. And we're also going to have a government bond. We're going to make it a zero coupon government bond, just simply to save on notation. Nothing would change if there was a coupon here which was non-zero. We just carry around more constants. And of course, the action is going to be in assuming a financial friction. And the financial friction is going to be the simplest of all possible financial friction is going to be a liquidity in advance constraint. So in order to go to the shop and buy myself a liter of milk, I need to have liquidity. And liquidity, as you will see, is an aggregate of both money and bonds. It'll be a sticky price story, with sticky prices a la Calvo. You'd expect that on a Calvo paper. And of course, there's a dynamic optimizing model, but I'm going to skip all of that. I will just give you the very, very, very reduced form version of the model. So there's a definition of liquidity in which liquidity is going to be a Cobb-Douglas aggregate of money and bonds. And the thing that I want you to focus on is this thing Q here, which is the price of bonds. And a lot of the action is going to be there because that Q is a jumpy variable, and Q is going to be doing a lot of the work in the story we want to tell. There's going to be a liquidity advance constraint, so that deviations of consumption from steady state have to be equal to deviations of output from steady state because this is a closed economy, and you have to have sufficient liquidity to purchase consumption goods. And because of the assumptions we make, that constraint is going to be binding always. There's no uncertainty here. So if interest rates are sufficiently high, positive in fact, you will always have that the constraint binds, and that makes life very simple. There's going to be what we call a portfolio balance equation. You will hold money and bonds in proportions given by their relative returns. And what's going to matter here is IMT, which is the interest rate that the central bank pays on the money that I keep in my account in the central bank. And of course, the rate at which the bonds are appreciating or depreciating. There's no yield on the bond here because it's a zero coupon bond. I mean, the yield is implicit, of course, by the movement in the price, but there's no coupon. And finally, there's going to be just two identities, which money can grow, real money can grow, depending on the difference between the rate of money creation nominally, which is mu, and the rate of inflation, pi. And of course, bonds can also grow, and the rate of bond issuance is going to be zeta. The real rate of growth of bonds will be zeta minus the rate of inflation. That's the model. Okay, it took me about a minute and a half to tell you what the model is. Sorry, I was missing one equation, of course, the Calvo equation. How could I be forgetting the Calvo equation? There it is. You all know the Calvo equation. And the policy regime is what I think is going to be interesting here. You could imagine many policy regimes, but we're going to adopt one that has two attractive features from my point of view. Attractive feature number one is that it ensures uniqueness of equilibrium. People who play with these kinds of models know that certain kinds of policy regimes give you multiplicity or, in fact, an infinity of equilibria. So we're going to dispense with that. We're going to assume that the central bank sets the interest rate on money, which most central banks do. And we're also going to assume that the central bank controls the rate of growth of nominal money, of reserves. which central banks always also do, right? Central banks can say, I am going to be issuing reserves to buy bonds, for instance, and that will give you a pre-specified path for reserve creation, which in this model is equal to money creation. And everything else, including the interest rate on a pure bond, a non-liquidity yielding bond will be endogenous, and so will be Q, the price of the bond in terms of money. And of course, if the Treasury wants to issue bonds, that's also an exogenous variable. But from a monetary point of view, we have two policy variables, the interest rate on money and the rate of growth of money, and two endogenous variables, the across the board pure interest rate and the price of bonds. Okay, we have an extension in which we consider other monetary policy regimes. They're much more complicated. Nothing much is to be gained there. And this system can be boiled down to a 2-by-2 system, differential equations in inflation and real balances, which is pretty much standard. And this is the last ugly thing that I will show. It boils down to a phase diagram. I'm not going to show you phase diagrams. They can be quite complicated. I'm going to show you simply time passo variables. But for those of you who are technically inclined, this very little model boils down to a very little 2-by-2 system. You know, we had to do some work to get there because it's more complicated, but with suitable assumptions, you get there and you can get solutions that are entirely pictorial, graphical, very little algebra in this paper. All right, so enough equation writing. Let's get to policy. This is mostly a policy conference. So we want to use this model to answer two kinds of questions. First of all, what happens to the economy when you have different kinds of fiscal policies? And secondly, what should the central bank do in response, if anything? So we're going to study what we're going to call helicopter drops of zero coupon bonds. So the government announces a transfer. You can think of that transfer as sort of checks to households, which is exactly what the U.S. Treasury has been doing quite actively for the last year and a half or so. And then that additional transfer activity by the Treasury is financed by issuing bonds. But of course, nothing is lost by simply assuming that the bonds are dropped on people's heads and they can use those bonds for consumption or anything else they wish to do. Okay. And there's a government budget constraint in the background, but it doesn't really play much of a central role. So just to emphasize one important point, which I'm sure Christina will emphasize in her discussion, this is not a shock to government consumption. This is not a shock to government investment. So the government is not building more bridges or digging more tunnels. The government is simply writing checks. We don't think that this is entirely crazy, given that, that's what governments seem to do nowadays. They write a lot of checks, particularly in the US. So let me now give you some results. The first one is so simple that I'm not going to write any equations or anything. If the government says there's going to be a permanent and unanticipated increase in the stock of zero coupon bonds, so you wake up in the morning and the government says, in the next 30 seconds, I'm going to drop a lot of government bonds for you, and we will do so for 1 minute, and then we will stop doing it forever. That is going to have no real effects. And it's have no real effects because demand for bonds has not moved, and therefore, as the supply of bonds goes up, the price of bonds goes down, and nothing happens. This is exactly like the model that we all, or the story, or the result that we teach our undergraduate students in macro. It may or may not be true, but we teach it anyway. We say, if I double the money supply once and for all, I double prices. The real stock of money doesn't change. Interest rates don't change. Output doesn't change. Nothing else happens, right? So you have a spike in inflation, very, very brief, and that's the end of the story. So first result that is somewhat non-standard here, or entirely non-standard, at least when compared to the undergraduate textbook, is a once and for all fiscal expansion financed by bonds is going to have no real effects. Now, let me try other kinds of experiments. Suppose that now this is the policy in question. So that at time zero, people wake up, they turn on the television or the radio, or they go online, I suppose, what people do nowadays. And the government says, at time zero, today, T periods from now, where T could be a month or 6 months or a year, we will do a once and for all increase in bonds. So the helicopter, instead of going out today, the helicopter will go out next month, next quarter, at the end of the year, and pick the T of the length you want. And of course, qualitatively, the length of the T doesn't matter. Quantitatively, if you wanted to simulate this, the length of the T would matter a great deal. So that's the experiment. The helicopter will go out in the future. You can play with the phase diagram, but I'm not going to do that. I'm just going to show you the results. This is what happens to inflation. I put inflation first because this is an audience of central bankers. So inflation, I suppose, is the thing that we first worry about. What you're going to get is a temporary deflation, the rate of inflation, which was zero at the outset. We began with a steady state of zero inflation. Inflation will jump down, will become negative, will start rising, but only gradually. It will become positive before you get to the day when the helicopter drops will occur. And once the helicopter drops have occurred, inflation will, given that nothing else has changed, right? There's no change in monetary policy, inflation will converge gradually to the steady state level of zero. So you're going to get temporary deflation followed by inflation in the future, but before time t, and that inflation goes away. If you're interested in what causes this, or what the output version of this is, that's the output version of this. You begin at the steady state natural rate of output, which should be labeled over here, call it whatever you want to call it, Y bar, I suppose, is a standard label. When the government makes its announcement that that the helicopter will go out and drop bombs on people's heads in the future, output falls on impact, and then output begins to recover at some point before T, not at the same time when inflation becomes positive. You can't really see it from this picture, but if you look at the phase diagram, that's fairly obvious. At some point before T, although not at the same time when inflation becomes positive, real output goes above the natural rate. So again, you get a temporary recession followed by a boom, and of course the boom withers after the shock has happened, okay? So you may be wondering what's going on here. What's the intuition? Why are we getting these results? The government is engaging in what we're calling a fiscal policy that is expansionary, and you're getting a temporary recession. And the answer is this. The government is saying that you will have more bonds in the future, but bond pricing is a forward-looking exercise. So bond prices drop today. Bond prices drop today in response to the future expected increase in bond supply. So the bond component of liquidity has gone down. What about the money component of liquidity? Well, the nominal money supply is constant. I'm not changing that. I'm starting from a steady state with nominal money supply. Maybe I should have made that explicit at the outset. And the price level is sticky. In the Calvo model, the rate of inflation can jump, but the price level is sticky. So real balances cannot jump. So if the real value of bonds is going down and the real value of money on impact is not going down, the real value of liquidity as a whole must be going down. And because of the liquidity and advance constraint, suddenly people want to have more liquidity. They don't. They know that they will have liquidity in the future, but they don't have it today. And as a result, consumption goes down, aggregate demand goes down, output goes down below the steady state level, and that is why you get temporary deflation. Okay, so our story here is very simply, you can, in this story, because bond prices are jumpy and because bond prices are key for liquidity, you can get very non-standard, maybe Christina will not find them non-standard, I don't know, but to me at least they were pretty non-standard effects of this kind of fiscal policy. Now let me try something else, one other exercise, which is instead of saying that bonds will simply rise T periods later, at time T, at time zero, people wake up and the government says, the Treasury says, we're going to be issuing some bonds. The nominal stock of bonds is going to be growing at some rate zeta between today and time big T. And at time big T, we will stop printing nominal bonds. Okay, so the helicopter will be active and the stock of bonds will be rising. The log would be, of course, a straight line, but this is just the level between time zero and time big T. Okay, so this is maybe a little bit like what fiscal policy looks like nowadays. The government says, for the next 6 months, I will be sending checks to people, and presumably in 6 months, COVID will be over, so I will stop sending checks to people. And if it's all bond finance, this is the kind of trajectory you would expect for bonds. Well, given that, again, you can play around with that, but I'm going to skip it. And quantitatively, the story is going to be differently, but qualitatively, the story is going to be the same. You're going to get, again, a recession. Why are you going to get a recession? Because bonds are growing very slowly, bond supply is growing very slowly, but the price of bonds jumps down, takes a step jump. So again, the real stock of bonds is gone down on impact. The real stock of money cannot change because prices are sticky and nominal money is not changing, and therefore you get a liquidity crunch. And as a result of the liquidity crunch, you get output going down, and you also get, I told the story the other way around here, I jumped to output because I think it's sort of the more surprising part of it. You're going to get inflation being negative, you get some deflation. Inflation returns to zero before the end of the period of fiscal expansion, and then the rest of the story you can see. Okay, so that's the fiscal part of the story. I have about 5 or 7 minutes according to my watch, so I have time to tell a couple more stories. The question that I want to ask in the next 5 minutes then is, can monetary policy do something to offset the contractionary effects of fiscal policy? I'm not going to say should. I'm not going to ask that question because I don't have, a model of optimal policy. I don't have a social welfare function. I'm not deriving this from utility maximization, et cetera, et cetera. So I'm simply going to ask, suppose that the central bank watches what the Treasury is doing, and suppose the central bank doesn't like this, okay? And it's not surprising the central bank wouldn't like it because it would seem to violate the mandate of a central bank. Central banks have an inflation target. In this very simple model, the inflation target is zero, and suddenly the inflation rate is negative, and it's going to be negative for a while, and it's going to be positive for a while. And that violates what the central bank is doing. What the central bank ought to be doing, what the central bank's mandate is. So you could imagine the central bank would want to intervene. Now, it is pretty easy to show that central banks can do things that will keep inflation at zero and output at its steady state level, but a Taylor rule alone will not do. Okay. In the beginning, we didn't see this. We played around with a bunch of Taylor rules, but a Taylor rule alone will not do. For 2 reasons. First of all, because you quickly enough run into the old friend of the zero lower bound problem, but more fundamentally and more in a more novel way, if you want, because it's not simply interest rates, but stocks of liquidity that matter. And again, that result that I had is that if nominal money balances are constant, the stock of real money is constant, at least on impact, because prices are sticky. The prices of bonds are falling, so you are going to get a recession pretty much no matter what you do with the interest rate. So yes, you can find a path for nominal money joined to a path for the nominal interest rate, which will keep inflation at zero always, and which will keep output at the steady state level always. But that's going to be a policy that is a little bit QE-like, okay? So if I go back to the once and for all anticipated and permanent step helicopter drop of bonds in the future, so this is the first exercise that I did about 10, 15 minutes ago. And I asked, what is the policy that the central bank would have to follow? Here's one policy. It's not a unique policy in the sense that you could achieve something similar if you didn't keep the interest rate at zero always, but I'm going to keep the interest rate at zero always because that makes the initial step increase in money supply that is needed smaller. Okay, you don't want the price of bonds jumping around a lot, and therefore the lower you can make the interest rate, the smaller that jump is going to be. But because the jump will always happen, the only way to avoid that jump is making the interest rate on money negative, but we haven't allowed for that. Maybe we should, some people think that's not the end of the world, but we haven't gone that route in that paper. You're always going to have a discrete drop in bond prices. You can attenuate it with cuts in interest rates, but the zero lower bound will not allow you to do away with that entirely. That means that you're going to have to keep liquidity constant by means of increasing the money supply. And so this is the path that is the money supply is going to have to follow: a jump, then an increase, and then when the helicopter comes and drops a lot of bonds on people, the money supply will have to drop again to keep liquidity constant. So there is a policy that will accomplish this goal, but it is a QE-like policy. If I now think of the other exercise, the exercise in which you the Treasury gradually increased the stock of bonds out there, then again, there is a policy. The policy looks a little bit different. And the reason why it looks a little bit different is that in the previous case, there was a jump in the quantity of bonds at time t. Here, there's no jump in the quantity of bonds at time t. The bonds just simply, go up gradually. And therefore, again, if you keep the interest rate on money at zero always, you're going to have to do a larger increase in money supply initially, and then you will have to be mopping up that money supply in the course of the period between 0 and t. So I don't want to, make people dizzy with the details. The point here, the broader policy point is that, yes, you can offset these policy effects, these unwanted or these surprising effects of fiscal expansion, but you have to engage in a policy that is a little bit like QE, or if you want to put it this way, which is a little bit like financing the transfers with money, not only with bonds. A couple of caveats, and I will end. I think I'm almost out of time. One caveat is that I mentioned it at the outset, but let me repeat it. We've only analyzed a particular kind of fiscal policy, one in which it is all transfers, all check writing. No consumption, no investment. If you had consumption or investment, you would have two forces at work. You'd have the standard Keynesian aggregate demand effect. The government wants to eat more, that other things equal increases aggregate demand, but you still have these non-standard or liquidity effects at work, and it would be a quantitative empirical matter as to which one is bigger than the other. The other caveat, or the other way, or the other point that I want to make is not quite a caveat, is that there's a lot of discussion of fiscal dominance nowadays. Of course, if you come from emerging markets, that's a very old discussion, and in the rich world, that's a new discussion. And there is a kind of fiscal dominance here, if you accept that central banks ought to worry about the prices of bonds, but it's a different kind of fiscal dominance. Central banks are not being called upon to finance government deficits. Central banks certainly don't like to do that. Central banks are being asked, in the story we're telling, to carry out the second part of their mandate, namely to guarantee financial stability. And they're guaranteeing financial stability by doing things to the money supply and doing things to the interest rate on money that guarantees stability in asset prices and therefore stability in presumably financial markets, although we don't model here. My last slide then is that in today's world, and there's plenty of evidence about this, money is not the only source of liquidity. Lots of other things, including government bonds, lots of other assets provide liquidity, but money is priced differently than any other kind of asset. The price of money is not jumpy in terms of goods, but the price of bonds in terms of money and in terms of goods is jumpy. And that has, we think, that's what we want to argue, interesting implications worth exploring, both for fiscal policy and for monetary policy. So we have seen that fiscal policies can be neutral, fiscal expansions can be neutral, certain kinds of fiscal expansions can be contractionary, They can be deflationary, and there are monetary policy responses that can offset this, but they require QE-like behavior of the kind we have seen in the world. So it is in this sense, and I will end here, that in our world, monetary and fiscal policies are two sides of the same coin, or if you prefer, they are joined at the hip. Thanks very much.
Thank you very much, Andrés. A very clear presentation. Let me pass the word now to Cristina Arellano. She's Assistant Director at the Federal Reserve Bank of Minneapolis. She's been there for some time. Previously, she was at the university at the Department of Economics, University of Minnesota. She's been writing quite a lot on international debt issues, macro more generally, published widely in journals including the AER, JME, and other journals. Cristina, the floor is yours. You have 50 minutes to present your discussion. Thank you.
Thank you very much. Can you hear me?
Yes.
I think yes. Okay.
Yes.
So first of all, thank you very much for the invitation to participate in this conference. Let me start with my disclaimer. The views here are mine and not those of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. So I very much enjoyed reading the paper. I think this is an important paper that studies the interactions between fiscal and monetary policy through liquidity needs. As sort of Andrés, we just saw from Andrés, both government debt and money fulfill those needs. Empirically, I actually am sold with the idea that studying debt finance transfers and quantitative easing policies is first order. These have been crucial policies that have been implemented by many countries. During the COVID recession and also the Great Recession, these are the large packages have been mainly driven by this combo, debt finance transfers and QE. Moreover, QE tools are likely going to stay with us for a while due to the low interest rates. And, at low interest rates and the ELB, government bonds and money are good substitutes, perfect substitutes even. Now, although empirically this is important, theoretically, most monetary models abstract from government debt, and especially government debt as providing liquidity. Despite the fact that this is a first order interaction in the current environment, as we saw yesterday from Annette's presentation in the example of March 2020 in the US. Mm-hmm. So in this sense, this paper, it fits right in because it provides a framework, a rich framework, and develops these novel interactions between government debt and monetary policy. Let me motivate a bit just to show you. I'm sure many of you have seen this, but it's striking. So this is the path of government transfers and government debt in the United States from 2000 until the first quarter of 2021. And you see that, for example, in the COVID recession here, so there was this large increase in government debt, from over like about 100% to 130% of GDP. And that was basically almost all used for transfers, both in the form of checks, but also all the unemployment insurance. This was also the case during the Great Recession. The increase in the government debt here financed largely the permanent increase in transfers. So, this is really like a first order. This is what has been happening in the recent recessions, together with Fed balance sheets increasing a lot. So in the case of the US, for the COVID recession, the Fed balance sheet increased from about 18% to 35% of GDP. So this is the background, and the paper is about the framework. So let me give you a little bit more details, and Andrés already did a great job. I have a bit of a repeat here just from the way that I understood the paper. Mm-hmm. So the paper analyzes the effects of government debt expansions, and the key element here is the fact that government bonds and money have a liquidity value, and they're basically needed for consumption. is something extra relative to what Andrés mentioned, is that they actually consider long-term bonds, which means that the liquidity services of debt here are going to matter not only because of the level of debt, like the Z variable, but also the price of debt, a Q variable. And this is going to be the crucial endogenous price. The second element is sort of the standard aggregate demand effect with sticky prices with a Calvo-Phillips curve. As Andrés mentioned, there's these two policies. So fiscal policy is going to control the debt, Z, and monetary policy is going to control sort of money balances and the interest rate on money. They consider, as we saw, policies that are permanent or transitory or unanticipated, and the details matter. These policies can lead to recessions or expansions. So I'm going to repeat a bit the exercises that Andrés did. Consider first the case of, but I'm going to focus on the effects of the price of bonds. So consider first this an anticipated increase in money. So at time zero, the fiscal policy announces that bonds are going to increase, to this blue line permanently and forever. The main thing is that sort of what's relevant for output is not the level of money, but the value of the level of debt, but the value of debt. And in fact, output is going to depend crucially on this value. So what happens is that because the price of debt is a jump variable and can adjust, it's going to jump down and perfectly offset the increase in the level of debt so that the value of debt is unchanged. And that's needed for a sort of a stable new equilibrium without inflation and neutral output. Note, though, that in this equilibrium, real rates, so the real yields on government debt, are higher permanently, but that in this environment has no output effects. The second policy that we just saw is this one, and as when the government, I'm going to do it in a little bit different order here, the government temporarily increases the stock of government bonds, and they're going to reduce it later on. Okay. So what happens is that the price of bonds is going to adjust, okay? And in general, it's going to fall due to the higher increase in government bonds. Also, it falls because it has these future expectations of prices that in the new steady state, in the new equilibrium in the long run, that price is going to recover. And so the price of bonds is going to fall, but not enough to compensate for the increase in government bonds, which implies that in the short run, the product of the value of the debt is going to go up. This is the black line here, and is going to create a temporary boom. Okay. Eventually, the price, the economy is going to, the price is going to fall for a while and then increase together with the dynamics of inflation that we saw. And that is going to lead to a sort of an eventual recession prior to converging to the new steady state. But you can see here that it is the response of the price of bonds that do not completely neutralize the increase in debt that leads rise to this boom, a temporary boom. Finally, the last policy is this policy that is anticipated but permanent increases in government bonds. And so what happens is that, again, although sort of in the interim, there's no change in government bonds, the announcement of a future increase in government bonds is going to lead to a fall in the current price because of the forward-looking variable and the fact that eventually that price is going to fall. So sort of the fact that this is sort of a long-term price means that those future expectations happen or have impact immediately upon the announcement, which leads to a decline in the value of debt, and that's what's causing sort of the early recession. So sort of as Andrés pointed out, and I'm sort of highlighting more in my discussion here, sort of how the dynamics of the price of bonds and what happens in terms of sort of smoothing those fluctuations, plus the future expectations of the whole path feeding into the present is what's going to be an important element for whether or not, what the effect of these policies are. And they can be, they can vary. Now, sort of in these type of exercises, and that's the way that the paper proceeds. In the first exercise, monetary policy is held constant, so the nominal money supply is fixed. But of course, sort of in this framework, because both money and bonds enter into these liquidity needs, and that's what's sort of crucial for output, monetary policy could prevent these changes in liquidity by, for example, the easiest way is just changing the money supply with a QE type policy. Okay, so here are my comments. So I think that, and I think Andrés already did a lot in the discussion, but I think the paper could develop more in detail the dynamics of the bond price and sort of decompose a bit how these expectations, what is driving those dynamics of the bond price, and highlight that the expectations with this long-term debt are going to be crucial for the effects on the policies and on output and inflation. Also, the paper analyzes the case where this liquidity constraint is always binding, but presumably changes, especially large levels of debt, could get households off their cash in advance constraint, and could be useful to analyze that case as well. In terms of the monetary policy, and Andrés highlighted this, it seems that a sufficiently flexible monetary policy can offset all fluctuations in output. So I think that it would be useful to think about a simple monetary policy. For example, sort of a strict inflation target, even if the instruments are sort of QE type instruments, but would a strict inflation target do the job? Or sort of an interest rate rule, like a Taylor rule, that has bond prices as part of the elements in the rule. So I had that question, whether that would do the job. Finally, I want to say here that the liquidity value of bonds that is here sort of a constraint directly assumed can be justified in the classic model of Haggard and Ayagari. Let me give a little bit of talk a little bit about this sort of work that we are doing, recent work with Mark Aguiar and Manuel Amador, that we're exactly analyzing the effect of government debt used for transfers in this type of model. And we actually find that combination, this is actually in a flexible price model, but the combination of government debt used for transfers can really give improvements and give rise to Pareto improvements, okay? So in the model of Haggard-Ayagari, sort of the level of wealth and the liquidity that households have are going to be, due to precautionary savings, are going to give rise to these liquidity effects that the paper the paper by Calvo and Velasco need for their results. This is basically a micro foundation of the liquidity value of bonds. Moreover, in that paper, changes in the government debt are going to lead to changes in the value of those bonds, the real interest rates, because of course, households are going to need to be compensated for holding those assets. So, sort of the elasticity of interest rates, even in the steady state, is finite. And again, this is going to be sort of give a micro foundation for these movements of bond prices, even in the steady state. Finally, so one thing that we find is that, and of course sort of is complementary to what they're finding, is that government used bonds for transfers in our model are, we are abstracting for this aggregate demand effect, but they are actually going to improve risk sharing, because this is going to lead to agents gaining from sort of getting the positive transfers. Of course, and this is at the end, Andrés talked about it, increases in government debt that increases interest rates are going to depress capital. And that could be a negative, okay? But we actually find that this might not be a concern, because when interest rates are low, okay, the government can use the senior revenue from selling those bonds to offset the crowding out of capital. Maybe I took a minute to do this graph. So this is the standard Ayagari graph, where in the x-axis is the level of savings of the economy, and in the y-axis is the interest rate. And this black line is the aggregate savings function, which is increasing in the interest rate. In the initial equilibrium without government intervention, there's an equilibrium level of interest rate where the total assets of the economy are equal to the capital stock. When the government issues debt, then that creates a wedge between the total private savings and the level of capital that actually is going to lead to an increase in interest rate. But sort of what we show in these papers, we provide sufficient conditions for which this sort of the revenue of the government bonds, which in this graph is this gray rectangle here, when that is high enough, then that can be used to offset the crowding out of capital that it arises because of increases in government debt. And sort of in that type of Pareto improving fiscal policies, basically, the crowding out of capital is not, it could be neutralized, and the government debt transfers basically lead to welfare gains unambiguously. So sort of this is going to provide a rationale for why, with low interest rates, Calvo and Velasco in a way are right to abstract from these crowding out effects. So let me conclude. This is the paper provides an interesting framework that integrates fiscal and monetary policy in a novel way. I'm totally sold that this is sort of empirically relevant emphasis on debt finance transfer. So I guess I'm not going to talk about government consumption. I'm sold on that exercise. The key prize is the interest rate on government bonds. And I also think it's a promising research agenda that is going to integrate the liquidity use of government debt with monetary policy. Thank you.
Thank you very much, Christina, for a very good discussion. So we have about 15 minutes. I want to remind people that are online that can ask questions, use the chat function, otherwise raise your hand. It's another possibility. Then I will moderate that and ask the question to the panelists. You get some further instruction now in the chat. I'm looking, and I already see that Augustine Carstens would like to ask a question. So can we open the line for Augustine, the General Manager of the BAS? Augustine, the floor is yours.
Thank you very much, Stein, and more than anything, let me thank both Andrés and Christina for their presentation and very good comments. It's always a pleasure to hear al gran maestro Velasco, in particular, when he co-authors a paper with the other Grand Maestro, which is Guillermo Calvo. I always learned a lot from their papers, and this was not the exception. Now, I will not dare to ask them any questions about the ins and outs of the models, because I'm sure they're perfect and they resonated with me. But I want to, I think your presentation, you started by claiming that should there be some form of financial stability mandate or objective in central banks? And I want to pick your brains and explore if that mandate, and also how would it be sort of translated into your model, if you agree with it, or if not, why? If that mandate is really different from an intertemporally consistent price stability objective. Because we can get lost with the mandates, but it's very difficult to think that the price mandate would be observed if there is a financial stability issue. And well, of course, the bond market is so important even for the transmission of monetary policy that it's very difficult to think that they shouldn't mind it. Now, the real question is then how much is an independent mandate, or is just another manifestation of the challenges that central banks face while doing their task?
Andrés, why don't you respond?
Thank you so much. Thank you, Agustin. Thank you, Christina, for those comments. One word on Christina's comments. I'm delighted that she's done the hard work of providing and thinking about the micro foundations of all of this. I look forward to reading that paper, and we very much agree that this is an area worth looking into. Thank you, Agustin, for that generous introduction. Let me clarify, though, that the only real gran maestro here is Guillermo Calvo. I'm merely his apprentice, but very, very happy to be writing a paper with him. Agustin is asking a really important question, I think. And I think the answer to his question that the model provides may not be the end of the discussion. Agustin asked, I'm going to rephrase his question a little bit. Suppose that government bond prices matter, which they do in the story we have just told. They depend crucially. Should the law of the central bank or the constitution of the country in question specifically tell the central bank to worry about financial stability in general or bond prices in particular? Or is it enough for the central bank to worry about inflation, and in doing so, it will deal with bond prices? This very simple model that we have discussed today gives a very simple answer, which I fear may be too simple. Here, if you worry about inflation only, because there's such a tight link between inflation and bond prices, worrying about inflation will cause you immediately to worry about bond prices. So in that sense, you don't need a separate mandate. Now, I do wonder whether that is a general result or whether that is simply an artifice of this, very, very simple model. Because I could imagine in situations in which, jumps in bond prices had consequences for other aspects of the economy, which don't necessarily show up in inflation today. I could imagine how jumps in bond prices could bankrupt sectors. It might require bailouts. It might change the composition of output. It might change lots of things that we care about, which may not necessarily show up in inflation. So the short answer is, in this paper, they're the same. It's enough to worry about inflation. But I suspect in reality, they may operate through separate channels. And while I have the floor, one quick rejoinder to something Christina asked at the end. A Taylor rule or an interest rate rule would do the work if we didn't have the zero lower bound. That's the short answer. But in order to prevent bond prices from jumping around, I need the nominal interest rate to be negative. So if the central bankers in the room are willing to live with that, I'm happy to live with that. But I'm aware that central bankers don't necessarily like that. But in any case, thank you, Christina, again, and thank you, Agustin, for that question.
Christina, thank you, Andrés. Any thoughts as well that you would like to bring in?
No, that is even with the zero lower bound, I think, so I think that a strict inflation target policy would definitely do all the job that you need here because of this tight link. Yeah. But the particular simple rule, it is not obvious that with the ELB, having the bond price as an additional term could potentially help you, especially if you're willing, if the rule is on money balances or on the money supply, sort of a more expansive rule, not just an interest rate rule, but just also for the QE type rule.
Thank you. We have another question from Per Johnson. Per, why don't you open up your line and come in from the Riksbank?
Yes. So I hope you can hear me. So thanks a lot for a very interesting paper and very good presentation. So, the bond price dynamics are absolutely crucial in the model. And I guess looking at the real world, we can buy that these are really jumpy. So I guess that's empirically verified. But what about the very tight link assumed to output and inflation of these bond prices? In the real world, after all, we observe these jumps in bond prices, but not corresponding jumps in output and inflation, I guess, to the same extent. So is that, something that troubles you a bit, that the channel is perhaps a bit exaggerated in your model? Thanks.
Andrés, go ahead.
That's a very, very good question. Let me say at the outset that, in any toy model, simplicity is key, and therefore everything is a little bit exaggerated. So I understand where the question is coming from. But let me go to the substance and make 2 points, one about the world and one about theory. My point about the world is that maybe the reason why we don't see deflation or contraction happening in response to bond price movements is that they're very short-lived. As soon as they happen, central banks seem to step in. And if I look at the taper tantrum, if I look at other tantrums, smaller tantrums before COVID, and if I look at COVID, yes, you had spikes, but the spikes lasted a few days. And you have central banks like the Fed willing to step in and buy $1 trillion worth of assets in the course of just 2 or 3 weeks. So I guess my hunch would be to say the reason why we don't see it in the data is that the central banks in the world, or at least central banks like the Fed, are doing what the second part of my paper suggests. They're stepping in to smooth these, maybe not entirely. In reality, they do have tremors, but they do get smooth over longer horizons. And my sort of theoretical point is that everything is very tightly linked here because we have a liquidity and advance constraint, and it's always binding, as Christina pointed out. In a more general model, that's not necessarily the case. In the defense of the model, I will say, if a liquidity and advance constraint is something you don't like, or is too tight, or is too simple, one can write, Guillermo and I have done it, somewhat more general models in which you have bond demand and money demand maybe arising from, say, money in the utility function, other kind of standard models. The algebra is more complicated. You get a lot more terms, but basically the result is the same. So yes, in a model, everything is a little oversimplified, but no, if you generalize the model, I don't think the basic insight will not go away.
Thank you, Andrés. You gave also a good introduction to the next person who has a question, John Williams, president of the Fed in New York. John, the floor is yours.
Thank you. And this is a terrific presentation, obviously a really important topic. And Christina, your discussion was absolutely fantastic, very illuminating as always. So that was great. I guess I'm going to pick up on a point that Christina made, and that is trying to understand how monetary policy and fiscal policy are interacting. And I guess my view is similar to hers, where you do this in terms of optimal monetary policy in response to these shocks. Maybe it does a better job of illuminating what monetary policy needs to do to avoid some of these outcomes. Fixed money supply or interest rate rules kind of don't get at that. So I guess that's a suggestion to, I think, get at that. The other, I guess, broader point is that is this really about the lower bound? You talked about that and that role, but it seems to be a more general point about liquidity services at any time, and the role of how does monetary policy optimally respond to different shocks. And I guess one question that comes to mind whenever we talk about QE or bond supply is, isn't there a role in the fiscal authority in terms of the decisions around debt issuance, whether they should be issuing debt at the short end or the long end? And how do you think about that in the context of your model? So again, thanks so much. A great presentation, great discussion.
So Andrés and Christina as well, if you want to comment.
Just very quickly, I mean, those are great questions for which I don't necessarily have great answers, but they do point us in direction which we should be going, I think, in the future. But just a couple thoughts. We have not, Christina said it, derived an optimal policy here. It's doable. But I'm willing to bet that optimal policy will involve two things. Some degree of stabilization of bond prices. If you had the standard sort of, quadratic function, minimizing deviations of output and inflation from steady state levels. So you'll get, the rule will involve some stabilization of bond prices. That's about what. And the question about the who or how is, can you do it via interest rates alone? And I'm pretty sure interest rates alone would not do it, only because of zero lower bound considerations. But I think that's clearly the direction in which we want to go. And in terms of should the Treasury be worrying about this, about sort of filling out the yield curve, I think the answer is yes. I mean, I can answer that question confidently because I used to be in that job, in a very small market. The Chilean Treasury worried all the time about where in the yield curve we were issuing. Whether we were issuing at the same main. Chile has a peculiarity, which the central bank also issues a lot of debt, a lot of its own bonds. So, we actually thought long and hard where we wanted to be, where the central bank ought to be along the yield curve. Was there a role for us in the provision of liquidity, et cetera, et cetera? So those are very live issues, which in the past we didn't think about very much. But in the current context, with so much debt out there, I think it is inevitable that we should be focusing on them.
So a couple of comments too on that. So in the model that we saw, and I think it's the right approach, there's a single long-term bond that affects sort of the matters for liquidity. But of course, sort of different maturities of debt will have different liquidity services. So in that sense, even from the point of view of sort of liquidity services, I think that thinking about short versus long issuances are going to matter. Or for the Fed, QE of which denomination or twist, all those details I think are actually very much to the heart of the liquidity services of government debt. That's one thing. Second, we've had some models that think about how the issuances of short versus long bonds are going to affect the relative prices of those two. And that could also be another avenue by which sort of if the fiscal authority wants to issue a certain amount of debt, then if it's thinking about liquidity provision, they might consider different portfolio of issuances to minimize liquidity disruptions, and that could potentially be doable because of these differential effects on different prices of bonds, given the different issuances. So I do think that the issuances. The term structure of the issuances is at the sort of heart of what the paper presents of liquidity services, and also at the heart of the effects on different prices of different bonds.
Thank you, Andrés and Christina. I want to encourage anybody that has more questions to come in. We have a few more minutes. There's one more already lined up. It's Thomas Halup from the Czech National Bank. Thomas, open your line and then you have the floor.
Thank you very much. Hello to everyone. I would like to thank Andrés for a very thought-stimulating presentation and Christina for really excellent discussion. I would like to say two things. One is about the motivation of the model. I agree that close to zero lower bound bonds and money become close substitutes. But I doubt that in reality this is true for households, like on the retail level. It might be the case for wholesale investors, financial institutions. But, I guess it would require a kind of more complex model with explicit modeling of financial sector to get this distinction. Moreover, institutionally, for financial investors, we have mechanisms that at least partly isolate them from swings in government bond prices, like hold to maturity accounting rules, etc. So this will be relevant in practice. And second, it's to play a kind of devil's advocate. If we really believe that fiscal expansions can be contractionary, isn't the best policy advice to go to the fiscal policy makers and tell them, hey, stop doing this? You're probably doing this because you think it's helping the economy, but it hurts. And at the most global or international institutions like IMF, World Bank, OECD, they still give advice to fiscal makers to continue with the fiscal support. I'm not sure where the BIS stands at this, but basically what the paper says is that fiscal policy is doing harm, and if monetary policy is properly, it can clean the mess. But if we really believed literally in the mechanisms of your model, wouldn't it be better to recommend fast fiscal consolidation? Thank you.
Thank you, Thomas. Yeah, I'll let Andrés, with the perspective of his model, answer these questions.
Yeah.
Thomas.
Great questions, all of them. And let me say at the outset that I thought Christina's last answer was, really good, much better than mine. In pointing out that yes, liquidity will depend on maturity, right? So in a richer environment with lots of different bonds, the different liquidity effects will be different, but the Treasury ought to be worrying about that. Very important point. But let me turn to this. There are two questions here. The first one, let me begin with the last one. If this is bad, why do it? I guess my answer would be twofold. First of all, there are many other reasons for carrying out fiscal transfers than simply Keynesian stimulus. I think lots of governments are doing this basically because of health or humanitarian reasons. There are people who can't leave their homes and they have no purchasing power. So once you accept that transfers are necessary, not for macro reasons, but for simple reasons of humanity and human welfare, then the question is, well, how do you ensure that they don't have bad effects? The answer in this case is, well, you need a monetary policy that goes hand in hand with the fiscal policy. I suppose the other half of the answer is, as COVID begins to recede, and let us all knock on wood that that's happening, then probably you want to change the composition of the policy. If, in fact, you are thinking of fiscal policy for Keynesian reasons, and I have no intellectual or ideological objections to that, well, maybe you want to move from a policy in which it is all transfers to a policy in which there's actual real government spending. And, conceivably, that's what the US is doing, moving to infrastructure and building actual things that will require bricks to be laid one upon the other that will generate real demand. And on the point of are the liquidity constraints really relevant for households? I'd say two things. First of all, it's not government debt in the world alone that provides liquidity. We've had lots of other things that provide liquidity created by financial markets over the last few decades, right? Go back to the great financial crisis of 10, 12 years ago, we all worried about the shadow banking system and about all kinds of securities being put together by slicing and dicing mortgages, etc. Those also played this role. So my first point is there are lots of liquidity substitutes out there, and we have to worry about all of them. And secondly, you're absolutely right. The reason why we jump straight from the central bank to the household here is that there's no financial sector. But I could put in a banking system. I could have the banks be the only holders of reserves at the central bank, and then in turn the banks would issue deposits. Deposits would be used by households, and you'd get very much the same story with more complications and a lot more algebra. Pretty much the same story. So. The optics may be wrong, but I think the substance of the model in that regard is okay. It's not misleading.
Thank you, Andrés. We're coming to the end, but maybe Christina, if you have some last observations here on this topic.
No, just to echo a little bit what Andrés said. So in this work actually that we are doing with Mark and Manuel, a key thing that government debt and with transfers financed with government debt does is precisely risk sharing. So, we don't have any Keynesian elements, and that there's a rationale for that type of policy, even absent, humanitarian reasons, just standard sort of risk sharing for income shocks or unemployment. So I completely agree. Once you think that is necessary or that's part of improving welfare, then this aggregate effects that we can deal with are useful to study. So that's my 2 cents there.
Thank you, and I wanted to thank both of you who come to the end of the seminar. Andrés and Christina, very much interesting discussion. Also, thank you very much to the participants. We're going to continue our series later this week. You're all invited as well to join on Friday at 12:30 Central European Time. We start with a panel on women in central banking. And then we continue at 2:15 in the afternoon, a presentation by Professor Mian, who will speak on inequality in central banks as well. So again, thank you all for participating, but especially thanks for Andrés and Christina for a very nice discussion and presentation. Thank you.
Thank you.